All right, well, let's talk a little more about Reliance's numbers. All the business segments clocked in strong growth. The revenues went up 11%, EBITDA rose 14%. We have Probal Sen, who's the energy analyst at ICICI Securities, and Karan, the media analyst and senior VP, research analyst, media, consumer, discretionary and internet at Elara Capital. Gentlemen, morning to both of you. Probal, let me start with you. The oil to chemicals business was very strong. Margins were at a 5-month high. But do you oppose these numbers? Would you raise your estimates, earnings estimates on the stock, on the company, and your price target as well? Just take us through the rationale.
I think the O2C segment needs to be looked at a little bit in context of what has happened over the last second half of the year, where the extent of crude advantage that companies like Reliance and even indeed the OMCs managed to get, partly from higher volumes coming through from Russia, but also, as the company mentioned in its presentation, it optimized the offtake of appropriate Latin crudes, which actually helped deliver some of the refining advantage that has come through in the O2C numbers. There has been some marginal improvement, at least on a sequential basis, in key petrochemical spreads as well. But if we look at what is happening in terms of FY25, the start of the year has actually seen a little bit of a depression in terms of refining margins, particularly in terms of the Singapore benchmarks. And on the petrochemical front, the demand-supply situation continues to remain fairly bearish. So from a growth perspective, I'm afraid I would still look at low single-digit growth going forward from the O2C segment overall, because slightly better refining, and even if there is some improvement that comes through, can be offset probably by flattish petrochemical. There could be some improvement in terms of petrochemical margins if there is some sort of supply optimization that happens in response to slightly weaker demand. But at this point of time, we would be probably cautious of building an extremely high growth from this higher base, which in itself is fairly significant.
Okay.
Okay, all right. Got that, Probal. Coming back to you, Karan, let's get you in the discussion as well. The retail part of the business was a little bit softish, but there was some easing out in terms of the net debt. What are you factoring in on the retail part?
So I think if you look at the retail business, I think the growth has been slightly, muted, but we've come up from a festive quarter. So I think in terms of the annualized growth, if you look at the numbers are good at about 18-20%. If you look at Reliance as a play, I think it's an omni-channel play. So you have got a very strong addition in terms of physical stores as well, and plus sizable online presence. 2-3 trends, I think, which are going to emerge strong, for the retail business. One is, the offtake of private labels. There are 3-4 brands, which have crossed a turnover of 2,000 crores on the private label side. Now, that is a very compelling sign because the market is getting displaced by larger incumbents, on the retail side. So that's one. And secondly, very strong growth in the luxury segment. So the premium segment growing by 20%, luxury segment growing by 40% plus. I think these are very strong signs. And third, of course, is, the e-commerce play and the omni-channel play. So if you look at most of these companies today, the quick commerce companies, the e-commerce companies, they are growing at a faster clip versus traditional retail. So I think these three drivers are going to fill up the momentum for the retail business going ahead.
And what is your target price on the stock now, Karan? And have you raised your earnings estimates for, of course, the retail business you said has been slightly muted this time. But going forward for FY25, what would the estimates be on the retail business and what's the target price?
So our overall target price as a house is about 3,500. In terms of specifically retail, not much change as far as estimates are concerned. I think the growth rates will be in the range of 15 to 17% with a steady improvement in margin, basis the levers that we pointed out.
Okay. And Probal, same question to you. For FY25, the oil to chemicals business, what is the performance looking like and what kind of EBITDA growth are you expecting to see?
So we are looking at actually a flattish EBITDA at around 62 to 63,000 crore for FY25, with a little bit of growth back to about 64 to 65,000 crore for FY26. And our target price for the stock right now is 28.10 with a rating of hold.
And this potential production upside of 15% from KG-D6 in the medium term, has that come as a positive surprise to you? What was your own expectation?
Yes, I think once the approval comes through and the developments actually play out, this actually sets pace for growth even beyond the current plateau of around 30 to 32 that the company had been guiding for the next couple of years. So as and when the execution happens, definitely I think this sort of adds a small leg of growth. But it's obviously the approval has come through now. As you know, all of these fields are fairly complex fields to bring on stream. So probably around 2-3 years down the line, this additional production will come through. Definitely makes a difference in terms of the DCF prospects of the upstream asset. So it is definitely a positive surprise.
Okay, so it's a positive surprise there. Karan, coming back to the retail business, right? I take your point that maybe the top line growth was modest at 10%, considering there's so much competition in this space right now. But two things which stood out to me as positive in the retail business. One is that they're taking a lot of hard decisions to cut costs, right? So whether it is bringing down their warehouse costs, or even they've sold some of their warehouse assets. They saw high level of store closures as well. So that perhaps will help them on the operational front. And the other one is their balance sheet has improved. So their net debt levels have come off, partially because of the capital raising that they did in FY24. But these two factors, would you consider them big positives, and would that give any incremental upside to the retail business?
Yes, going forward, potentially there could be an upside. But if you look at the business as such in terms of profitability, the online business, is kind of making losses for most of the new businesses that they've started. If you know, even Tira is something which they've started new, but they haven't, scaled up aggressively on Tira as well. So I think definitely from here on, there is traction, to improve. And many of the e-commerce companies are kind of, trying to invest in supply chain, reduce their fulfillment costs. And that is somewhere a margin lever, whether it could be, in charging convenience fee or platform fee, from the customer. So better profitability in the digital side will augur well for them. And second, of course, better growth, coupled with profitability, which is of utmost important. And as far as store addition is concerned, I think it does make sense. I think on a steady state, on this kind of a base, they will be adding not more than 3-4% of, store addition is concerned on this large base and this large categories that they have. So I think you will find some quarters, wherein the performance will be slightly muted, but, basis festive, basis overall annualized basis, I think there is good traction to grow at 15 to 18%, given the kind of widespread that they have across categories and the omnichannel approach that they have on offline and online.
Got it. Final question to you, Probal. We were talking about the improvement in the balance sheet, right? The reported net debt now is $14 billion, which has declined by about 8% year on year. And now that the peak capex of the company is over, do you think that they can strengthen their balance sheet further? And will that be an incremental positive for the stock going forward?
If the capex intensity actually comes down, absolutely, for sure. I think that's the one thing that will remain a key monitorable. We have seen in the past couple of years is that when one round of capex is actually completed in one segment, there's always been one more new segment, and that's the way that the company's DNA is wired. They're always looking for the next big thing and the next big project. So one will have to really look at whether the capex intensity actually comes down to levels of somewhere around maybe a 1 lakh crore a year, which is, I think, something which would still be about 20% lower than what they've done this year. If that happens with the kind of cash flow improvement that continues to happen and the steady 10 to 11% profitability growth that we are building in, for sure, I think the net debt or leverage should come down. The company has mentioned, however, that they are comfortable with the net debt to equity or leverage being less than 1, which it is right now. So I'm not too sure they would want to deleverage too much, given that their cost of borrowings are extremely competitive when you compare to any peer on the street or even the sovereign for that matter. But the return ratio improvement, which is something that has lagged earnings growth for a while now, I think if that starts to come through, that will be a big positive trigger for the company.
Okay, all right, gentlemen, thanks a lot for joining in and filling us in with your take. Wishing you all a good day ahead as well. So that's about Reliance Industries.